If your family has owned a significant piece of land, a heritage ranch, or a large acreage estate for a few decades, you're sitting on an incredible legacy. But you're also sitting on a massive problem if you ever decide to sell. Most long-term landowners feel completely trapped by their own success. They look at the appreciation on their property, realizing the impending tax bill could wipe out a third of their hard-earned equity, and decide it's just easier to never exit at all. I'm Mariah Jeffery, realtor, CCIM, and a licensed broker in both Wyoming and Colorado. Most agents will tell you that when you sell your primary residence, you can use the standard Section 121 tax exclusion to pocket $500,000 in capital gains completely tax-free if you're married. But what happens if you're selling a highly appreciated ranch where the total gain is $1 million, $2 million, $3 million or more? The standard exclusion hits a hard ceiling, leaving the rest of your generational wealth completely exposed to the IRS. You're left deciding between staying put or writing a massive check. Now, if you want to avoid this tax entirely, you have another option. It's called dying. Because when you pass away, your heirs get a step up in tax basis. Basically, the IRS resets the clock, the capital gains vanish, and your kids reap the rewards of your lifetime of hard work. But as a strategy, it's a bit of a commitment. If you prefer to enjoy your wealth while you're actually around to spend it, we need a better living solution. The strategy you need to know about is IRS Revenue Procedure 2005-14. It allows us to treat the ranch as a mixed-use asset. We don't have to choose between a primary residence sale and an investment sale. We can execute both on a single closing statement. Many ranches have a large acreage component, which may include outbuildings, fencing, and irrigation, as well as a residential component. The component that represents the family's primary residence for at least 2 out of the last 5 years can be separated and treated differently for tax purposes, excluding all capital gains up to $500,000. Let's look at a $3.5 million sale. We allocate $700,000 to the home and home site. Now, assuming your adjusted cost basis in that home is $200,000, you have a $500,000 gain. Because you're married, the Section 121 exclusion allows you to shield that entire $500,000 profit from capital gains tax, putting that equity directly into your pocket. Meanwhile, we take the remaining $2.8 million, the ranch land, barns, and water rights, and we treat that as business property. We roll the gain on that portion into a Section 1031 exchange, deferring the tax liability entirely. In a 1031 exchange, you're exchanging one property for another. Or in this case, you're moving from the active labor of ranch management into the passive world of income production. We can roll that deferred equity into a stabilized apartment building, a multi-tenant retail strip center, or a triple net lease commercial asset. Most brokers only look at the real estate side of the transaction. But when you're dealing with high-value acreage, the tax strategy is the real estate. My goal is to ensure that when the dust settles at the closing table, your net proceeds are maximized because we planned for the tax impact long before we ever listed the property. You aren't just selling a ranch, you're executing a tax-efficient wealth pivot and creating passive income for a more leisurely life in retirement. If you're considering listing a high-value heritage ranch, contact me, Mariah Jeffery with Coldwell Banker, and we'll discuss how to keep the most money in your pocket. If you're considering a transition and want to know how the mixed-use split could apply to your specific tax basis and property value, let's run the numbers. It's a custom analytical approach to exiting your position with as much wealth intact as possible. I'm Mariah Jeffery, and I look forward to speaking with you.